Welcome to the deep dive. Today we're taking on a huge topic, a nation-shaping event, really.
Absolutely. We're zooming in on Jamaica just a month after Hurricane Melissa.
And Melissa wasn't just a storm. It was a Category 5 system that just ripped across the island.
It was a historical moment. The sources we're looking at are clear. This changed how the entire nation thinks about its relationship with the land.
It forced this huge national reflection, right?
Yeah, and not just on the physical stuff like infrastructure, but on the core ideas of safety, of investment, of, where it's safe to build a future. It really did rearrange the mental map of the whole country.
So our mission for this deep dive is to get past those initial heartbreaking headlines. We're going to dive into the commentary, the research, all the early market data to answer one really critical question about Jamaica's real estate market. Have property prices fallen?
And we should just say this right at the top. The answer is not a simple yes or no. It's really not. If you're coming into this thinking you'll find a uniform, island-wide collapse in property values, the sources just don't back that up.
So what did Melissa do then, if it didn't just crash the market?
It did something much more surgical. It didn't collapse the market. It reallocated value. It was like a massive audit that tested and then repriced risk.
Okay, so resilience is now expensive.
Very expensive. And vulnerability now comes with a huge discount.
That idea, the reallocation of value, that's the key thing we want you, the listener, to hold on to throughout this whole discussion.
Yeah, it's the core insight.
It's what turns this from just a disaster story into a real economic analysis. There's a powerful quote we found from Dean Jones. He's the founder of Jamaica Homes.
Oh, yeah.
He says, "A storm is not the end of a community story. It is the moment the real story begins."
And that's what we're here to unpack, that painful, complex, and often really counterintuitive new reality.
So to really get the scale of this change, we have to start with the baseline. What did the market look like just before Melissa hit?
Exactly. You can't measure the change if you don't know what the pressures were that the storm was, walking into.
And the sources are clear. The Jamaican housing market was already a pressure cooker.
Oh, 100%. It was a hot market that was already straining under its own tensions. You had demand that was just consistently rising way, way faster than new housing supply was coming online.
And that was made worse by climbing construction costs, right?
Yeah, which made it even harder for developers to try and bridge that gap.
And we can't forget the diaspora.
You can't. That's the unique engine of this market. You have this growing number of, cash-rich buyers from the U.S., the U.K., Canada.
The Jamaican diaspora.
And they're competing, often aggressively, for that limited housing stock. Especially in the good parishes, the desirable coastal spots, it just created this immense upward pressure on prices.
So what are we talking about in terms of scale, the total value of the market?
It's massive. By 2025, the total real estate stock in Jamaica was valued at nearly $90.9 billion US dollars. It's a huge asset base. But, and this is the important part, the sources show that the internal dynamics of that valuation were really uneven. There were already structural problems.
Uneven in what way?
That unevenness is key. There was this severe scarcity, a real squeeze in the mid-range brackets.
The sweet spot for like an ordinary family.
Exactly. For your ordinary, upwardly mobile Jamaican family. We're talking properties in the $15 million to $35 million range. That's where local professionals, first-time buyers, returning residents, they were all struggling. The supply just wasn't there.
Which led to bidding wars, inflated prices.
Intense bidding wars.
Yeah.
And yet at the very top end, $40 million, and up the sources noted an oversupply in certain luxury segments.
That's the paradox, right?
It is saturation in high-end resort areas, but the family home market was desperately tight. So you had this dual market even before the storm.
Scarcity at one end, saturation at the other.
Yeah, and that kind of environment creates its own instability. It meant that land scarcity was pushing people, developers, and individuals into what the sources call a dance with both opportunity and risk.
So they were making choices that were financially dangerous.
Deliberate, but dangerous.
Can you break that down for us? What were those specific risky choices people were making?
The pressure was pushing people towards land that was either cheaper or had, that scenic value, but they were overlooking the safety trade-offs.
Okay.
So the first risky choice was building deeper into gullies, into floodplains, land that was available because historically it was seen as too risky.
And the second one?
The second, especially for high-end and tourism properties, was edging right up to the sea,
Yeah.
maximizing that incredible view, that direct access,
But also maximizing the exposure to storm surge.
directly exposing themselves.
Yeah.
So these were decisions that prioritized the immediate financial gain or the view over long-term resilience.
And then Melissa arrived.
And Melissa's arrival was basically a national audit on every single one of those decisions.
And that dance with risk just stopped.
It stopped instantly.
Yeah.
And that takes us right into the immediate aftermath and the just overwhelming scale of it all.
The physical impact was, it's hard to even wrap your head around the numbers.
It really is. We're talking approximately 150,000 homes damaged or completely destroyed, just in Jamaica.
Think about that on a human level. Nearly 1 million people affected.
1 million people!
Yeah.
A staggering proportion of the population instantly facing housing instability.
And the economic hit, when you compare it to the size of the national economy.
It's jarring. Jamaica's GDP is around, US $20 billion. The initial damage estimates are in the range of $5 to $10 billion.
Wow.
So Melissa potentially wiped out between 25 and 50% of the country's entire annual economic output in just 48 hours. That's a generational blow.
And the destruction wasn't spread out evenly. It was brutally localized.
Exactly, which is why that audit metaphor is so fitting. It wasn't a blanket of destruction. It was targeted by physics.
Right.
UN and media reports pointed to specific areas where it was near total. Towns in St. Elizabeth and Westmoreland where up to 90% of the buildings were impacted.
90%.
When you see that level of localized devastation, you can't ignore the planning issues that allowed it to happen. It exposed, as the sources say, faults long ignored.
It just tore the facade off everything.
It did. It scraped away any sense of superficial compliance. It exposed the failure of poor or non-existent drainage systems. And maybe most importantly, it showed the consequences of all those informal building practices.
So when we say informal building practices, what does that mean in this context? What were the specific weaknesses that Melissa found?
It means building without the right permits or dodging inspections. It means using outdated techniques, substandard materials, often just to save a bit of money up front.
So things like
Not enough rebar in the concrete, using a weak cement mix, and the big one, not using modern hurricane straps to tie the roof to the walls and the walls to the foundation.
And when a Cat 5 hits,
Those weaknesses mean total structural failure. The roof goes first, then the walls just collapse. The damage becomes a literal roadmap of where the building codes were ignored.
which moves us beyond just the materials and into the psychological impact.
Which is maybe the biggest downward pressure on the market. Once the walls fall, the price on a valuation sheet is meaningless. The sources really stress this. The price of a house becomes a symbol of trust.
Trust that it will protect your family.
Exactly. And trust that your government and your community have the infrastructure to help you recover.
That Dean Jones quote really hits home here. In Jamaica, the true value of a home is not measured in dollars, but in the confidence you feel when the sky turns dark.
And that loss of confidence is not easily repaired. It creates an immediate crisis of habitable supply. It forced the government to act immediately.
The National Housing Trust, the NHT.
Right. They had to come in with extraordinary measures. They rolled out special home improvement loans, relief loans, and emergency plans for semi-permanent housing.
Just to cope with this sudden collapse in shelter.
A catastrophic collapse. The NHT is really a pillar of housing finance in Jamaica. And these loans were vital because they were designed for speed.
Bypassing the usual red tape.
Exactly. To get cash out quickly for emergency repairs, for a new roof, for drying out the structure.
But the demand must have been overwhelming.
It was. And that was the challenge. Balancing speed with preventing fraud, all while their own branches in the West were damaged. So it was a lifeline, but it couldn't solve the problem for 1 million people overnight.
So with that scale established, let's get to the core economic question. The repricing of risk.
This is the market inside the damage zone.
Where the storm reveals the truth about the land beneath it.
And this is where the repricing is brutal, and it's visible. We're seeing a surgical decline at the neighborhood level, not a national decline, a decline driven by vulnerability that is now, financially quantified.
And the most obvious place is those low-lying coastal strips.
Yeah, we're talking about the western parishes, St. Elizabeth, parts of Westmoreland's coastline, Hanover. They took the full force of the storm surge and the flooding, and the drivers of the price decline there are powerful.
Let's start with the most immediate one. Distressed sales.
This is a crucial concept. Distressed sales happen when homeowners, who are often underinsured or maybe had no insurance at all,
They just need to get out.
they need to liquidate the asset immediately to unlock cash, to relocate, to rebuild, to survive.
So what does that look like in practice? What kind of discounts are we talking
We're
about?
talking salvage pricing. The sources suggest that in the worst-hit areas, a property that was valued at, say, $15 million before the storm might now be on the market for $8 million, or even $6 million.
That's a 40 to 60% discount.
It is. And these are often fast cash sales to investors who are willing to take on the massive risk. The seller is prioritizing speed over value.
And that drags down the perceived value of every similar house nearby.
It sets the floor, which leads right to the second driver, buyer caution, or what we're calling perceived risk repricing.
Right. So even if a house wasn't totally destroyed,
If it's in a zone that was visibly washed out, buyers, especially diaspora buyers who need a mortgage, will heavily discount their offer. They know that future insurance premiums are going to be a nightmare.
so the lenders and the appraisers become the enforcers of this correction.
They do. An appraiser now has to factor in the new flood maps. If an insurer won't cover a property or demands a huge premium, the bank won't finance it. Or they'll demand a much larger down payment.
Which directly lowers the price the house can get.
Exactly. And then there's the third driver, stigma.
Which is more intangible but just as powerful.
It's the intangible killer of value. When those images of flattened town centers are broadcast globally, that perception sticks. It's hard to justify sinking capital into a recovery zone when safer options exist.
It cools investment for years.
For years, it affects everything. So, what specific types of property are now seeing the biggest price drops?
Right.
First, older concrete homes. Especially those that already had minor issues like a few cracks, now they're seen as a huge liability.
A guaranteed money pit.
A money pit. Second, any building that lacks those modern resilience features we talked about, no hurricane straps, no proper foundation,
And what about those places built right on the shoreline or in the gullies?
they're being severely penalized. Those subdivisions right on the shoreline are essentially unsaleable now without huge investment in coastal protection, which might not even be allowed anymore.
So let's shift to the second area feeling the pressure, the tourism-dependent luxury corridors.
Right, and this pressure is different. It's less about local distress and more about global confidence.
So we're talking about the high-end villas, the beachfront homes in the Montego Bay Negro corridor.
The assets that are tied to global tourism and short-term rentals, like Airbnb.
And these are often better built, right?
Often, yes. But they're facing a severe short-term wobble. Sales have slowed way down. We're seeing time-on-market metrics just stretch out. And pricing is getting softer because of the uncertainty.
Why is that global confidence link so critical here?
Because high-end tourism needs critical mass. It needs the airports open, the big resorts running, the whole destination feeling safe and ready.
And the recovery for those big hotels is going to take time.
A long time. The forecast is mid to late 2026. And in the meantime, tour operators are already diverting flights and tourists to competing islands.
Like the Dominican Republic.
Exactly. They're actively moving to capture that displaced business. So if the income stream for a villa is uncertain for the next 2 years,
The value of the asset has to drop.
it has to. That's the financial squeeze. A buyer isn't just buying a pretty house. They're buying an income-producing asset. So they're pushing back hard on price because they're factoring in rising insurance, higher maintenance, and 2 lost high seasons of rental income.
The math just doesn't work anymore at the old price.
The math has changed completely.
Okay, so we've established where the pain is, the vulnerable coasts, the tourism corridors, but now we get to the paradox of disaster,
This is the crucial, counterintuitive part of the story.
where value is holding firm or even going up.
Or even actively rising. This is the market just outside the damage zone. Disaster creates these 2 very separate markets.
Because the destruction of housing stock in one area makes the remaining houses somewhere else more valuable.
Instantly scarcer. And that scarcity effect drives movement and prices up in the adjacent, safer areas.
So buyer priorities have just completely shifted. Safety is now number one.
It's the core priority. Families who lost their homes, or even just those who want to move to avoid future risk, they're all looking for safer ground. They're looking for homes on ridges, on hillsides, in better engineered, elevated pockets of the same parish.
And these are the places that came through, Melissa, okay?
They survived relatively unscathed, and that track record of resilience is now their #1 selling point.
And you've also got this intense urgent demand from displaced families.
That influx of urgent demand stabilizes prices for good properties almost immediately. Renters and displaced families need shelter now, so we're seeing appreciation in structurally sound homes on higher ground that are still close enough to the regional hubs.
And what defines one of those better engineered pockets that can command a premium?
It's often the small details. It's the gated communities that were built with foresight. You know, proper drainage, backup water systems, and critically, underground power lines.
Ah, that's a big one.
It's huge. When the rest of the community is dark and flooded, a pocket with power and dry foundations commands a non-negotiable premium.
So let's talk about the biggest urban center, Kingston and St. Andrew. They weren't in the direct path of the worst of it. How are they doing?
The corporate area is pretty insulated from any kind of broad price crash. Kingston is the administrative, the financial, the professional hub of the country.
Unless the capital itself gets devastated.
It remains the primary gravitational pull. In fact, the storm is actually adding new layers of demand to the capital.
How so?
We're seeing what the sources call quiet appreciation. It's driven by a couple of things. First, displaced families from the West who have the means, the insured, the business owners, they're relocating to Kingston for stability.
And second?
Second, the massive recovery effort needs people. It needs engineers, bankers, NGO workers, and they all need housing in or near the city.
So paradoxically, Kingston benefits in the short term from the disaster.
It does. So the question for Kingston isn't will prices fall, it's will affordability ever get any better?
And the sources suggest.
They suggest it's unlikely. The demand for secure, well-located housing there is just too intense. The disaster just reinforced Kingston's position as the nation's most resilient economic center.
This brings us to what I think is the intellectual core of this whole deep dive. The idea that Melissa is fundamentally different, that it's not a shock, it's an audit.
That distinction is absolutely critical. Historically, big storms didn't permanently kill real estate values. You'd see a dip and then appreciation would come back, driven by reconstruction money. But 2025 is a different world.
Let's just quickly recall the scale of past storms for comparison.
Okay, so you had Gilbert in '88, massive, losses equal to 28% of GDP. Then Ivan in 2004, which damaged 14% of the housing stock. And Dean in 2007.
And in each case, the market eventually bounced back.
It did. But the sources identify 4 key modern differences that make that historical comparison flawed. 4 reasons why the repricing after Melissa will be deeper and more permanent in those exposed areas.
Okay, let's break them down. What's the first one?
The first one is the game changer. The financialization of climate risk. Global money is now pricing in the storm.
What does it actually mean?
It means climate risk isn't some abstract fear anymore. It's explicitly priced into global financial instruments. You have global reinsurers, catastrophe bond markets, climate risk modelers. They are all deeply embedded in Jamaica's economy now. Melissa didn't just cause damage, it immediately tested these programs.
Okay, can you explain what a catastrophe bond is and how it connects to the price of a house in St. Elizabeth?
Right. So a cat bond is basically a type of insurance. Big investors buy these bonds and they get high interest rates. But, and this is the key, if a specific catastrophe happens, like a Cat 5 hitting Jamaica, the investors lose their money, and that capital goes to pay for the losses.
And Melissa was a trigger event.
A major trigger event. So investors just lost billions. The immediate consequence is a global reevaluation of risk for the entire Caribbean and especially Jamaica.
So the reinsurers, who insure the local insurance companies, have to raise their rates.
Drastically, which leads to much higher premiums, higher deductibles, and new exclusions for properties in those high-risk areas. And as we said before, higher insurance costs get capitalized immediately, dragging down the property's value. The math just doesn't lie.
Okay. What's the second big difference?
The second is the diaspora buyer and digital connectivity. The diaspora are often cash buyers, but unlike in 1988, today they are sitting in London or Toronto watching real-time, high-definition drone footage of the destruction.
So they see exactly which street flooded and which one stayed dry.
Indisputable evidence. This has revolutionized due diligence. It makes it impossible to hide vulnerability, so it cools their appetite for those exposed coastal strips.
But it also creates opportunity for the smart investor, I'd imagine.
Absolutely. The shrewd investors are now aggressively land banking high-ground parcels. The bar for acceptable risk has been raised by this instant visual evidence.
The third difference is how property is used today, the Airbnb effect.
The sheer volume of homes now tied to short-term rentals means Melissa isn't just hitting private homes, it's hitting thousands of small businesses.
Right.
The perception of long-term disruption to that income stream can just shave huge amounts off the sale price. A villa that was a great business pre-storm is now a much riskier, less profitable asset, and buyers will adjust their bids down accordingly.
And the fourth and final difference.
It's the greater awareness of and demand for rigorous building codes and engineering.
Even if enforcement is still an issue.
Even then, the market is now willing to pay that resilience premium for properties that can prove they were built to modern standards. Buyers are now looking for the certificates, the evidence of resilience, not just the nice finishes.
And this whole modern reality, this audit theory, is backed up by actual academic research?
It is. Research by Nikisha Spencer and her co-authors provides the definitive evidence. They used geolocated sales data and linked it to hurricane intensity maps.
And what did they find?
Their key finding is irrefutable. Hurricanes reduce apartment sale prices in the affected areas, and the impact is statistically significant.
And it strongly supports the idea that this is a localized audit, not a general collapse.
Exactly. The research concludes the price impact depends on the parish, the type of home, the exact track of the storm. The takeaway is clear. Disasters reprice risk locally. They don't just move the entire market down.
Okay, so that gives us a really complex picture. Downward pressure here, a resilience premium there. For you, the listener, what are the critical, concrete things you should be tracking over the next 2 years to see where this is all going?
Yeah, what are the actual indicators? You have to move past the national averages. They're pretty useless here.
So look at the details.
Look at the granular data. The first thing is something called time on market.
Okay, why is that a better indicator than just the sale price?
Because time on market measures the speed of demand. It measures confidence. If elevated, well-built homes are selling in 2 weeks, and flood-prone properties are sitting there for 6 months or more.
That divergence is the clearest sign of risk repricing.
It's the clearest evidence there is. It shows you exactly where buyers want to be and what they're avoiding.
So we need that parish-level data, the transaction data.
Yeah, from the NHT, the Realtors Association, private valuers. That level of detail is essential.
Okay, what about the second category, financial and regulatory shifts?
The insurance sector is the key lever to watch. Look at premium trends, but also policy changes. Are they starting to write new exclusions for certain flood zones? Are deductibles for hurricane damage skyrocketing?
And what about the banks?
Watch their lending criteria. If banks start demanding a 30% or 40% down payment for properties in coastal zones, that's a direct financial penalty. It shrinks the pool of potential buyers and lowers the property's value.
And then there's the government's response.
The long-term signal is zoning and planning. Are they going to mandate coastal setbacks, rezone vulnerable areas, enforce stricter building codes? Slow enforcement means the dance with risk continues. Rapid, strict enforcement signals a fundamental shift.
And the final category is behavioral indicators, the human element.
This is all about the diaspora. We need to track their sentiment. Are remittances staying strong? If they perceive that Jamaica isn't rebuilding smarter, their investment will cool off and those prices in exposed areas will stay soft.
But if they start aggressively buying up high ground,
That's the most bullish signal you could ask for. The other thing to watch is the pace of reconstruction funding. A swift, transparent process builds confidence. A slow, bureaucratic one just prolongs the uncertainty.
so we've covered a huge amount of ground. To sum it up, Hurricane Melissa did not cause a simple island-wide price collapse.
Not at all. It kicked off a profound and immediate recalibration of value.
It wasn't a shock, it was an audit.
It was an audit. It tested the honesty of the buildings and the wisdom of the land use, and it reallocated value based strictly on elevation, engineering, and resilience.
Where vulnerability was ignored, prices are softening.
Dramatically. And where resilience was built in, value is stabilizing or even appreciating because of scarcity, and a complete shift in what buyers prioritize.
That Dean Jones quote again. Every storm redraws the map, not of geography, but of wisdom.
The geography is the same, but the understanding of where true sustainable value lies has been permanently changed. This is a story of learning, as one source put it. A storm changes houses, but it transforms people, and transformed people build differently.
So as you think about this massive shift, we want to leave you with one final provocative thought.
A question to mull over.
Since this is all about the repricing of risk and the perceived safety of land, if you're relocating to Jamaica tomorrow, how much more? What specific percentage premium would you be willing to pay for a house that's located just one street outside a known flood zone compared to one inside it?
And remember, insurance costs are probably going to climb in both locations anyway.
Right.
That calculation forces you to put a real financial number on your own peace of mind. And given the limited amount of high, safe ground, the competition suggests that safe haven premium is going to get extremely high.
It's a difficult question, but an essential one for the future of Jamaican real estate. Of course, remember this deep dive was for informational purposes only.
Absolutely. Always consult with licensed professionals before making any investment decisions, especially in a market changing this fast. Thanks for joining us for this in-depth look.
We'll catch you next time for another deep dive beneath the surface.